Hello, my friends. Today is December 21st, and this is Markets Weekly. So, this past week was a really volatile week in markets. We saw some notable selling after the FOMC, though we did rebound a bit on Friday. Now, as we've discussed before, these last 2 weeks of December are seasonally very positive. However, at the same time, Santa Powell did put some coal in our stockings. So, it looks like the remaining days of the year are going to be a struggle between seasonally positive flows and higher interest rates. So let's see what happens. In any case, today let's talk about three things. First, let's take a look at what's happening in Brazil as it seems to be embroiled in a fiscal crisis, and something like this should be a sign of things to come across the world. Secondly, now, many people were expecting housing to rebound after the Fed began to cut rates, but even after 100 basis point cuts of rates, we see mortgage rates still pretty elevated and housing market not doing so well. Let's listen to the earnings calls of two builders to try to figure out what's going on. And lastly, this past week, we also got meetings from the BOJ and the Bank of England. Let's briefly review what happened over there. Okay, starting with Brazil. Now, looking at this graph of the Brazilian real over the past couple months, you'll notice that everything began to go south sometime in November when they unveiled their latest budget. Since then, the Brazilian real has been depreciating against the dollar in a big way. So, what is it about the budget that spooked markets? Well, it's taking a step back. It looks like President Lula over there has been learning from the magic money tree people and just spending a lot of money. Now, Brazil's economy is doing okay. The unemployment rate is low, wages are rising, but at the same time, they're really spending a lot of money. Looking at this chart here, their fiscal deficit is about 10%, which of course is very high. In the US, we have a 6% fiscal deficit, and that's way too high. 10%, much, much higher. Now, typically what happens, and of course, government spending too much money is something we see over and over again throughout history. It's really super common, and I would say inevitable for any group of elected people, because at the end of the day, you're spending money that's not your own in order to benefit yourself and your lobbyists, right? If you promise to spend more money, you can get elected, and then you can spend money to support your donors and so forth, and that's not your money, so who cares? So it's something that happens basically all the time. Now, the classic signs of a fiscal crisis are obviously first, your currency depreciates because the government, when it spends money it doesn't have, it does so by printing debt. Now, some people think of this as borrowing, but I think of this as, I think more accurately in the financial system as buying goods and services and paying with newly printed debt, which is really just money that pays interest in a fiat system. And so when you do this in a big way, obviously your currency will depreciate. Now, the corollary to this is, of course, when you're doing tremendous fiscal deficit spending, it's inflationary. So you would see interest rates shoot up. And oftentimes you would also see the stock market sell off. Although in extremes, of course, the stock market crashes up, as we see in countries like I don't know, Argentina. But in any case, at the moment right now, we do see the Brazilian real depreciate significantly against the dollar. Now, the central bank over there has been trying to stop this massive depreciation, and they do this by offering dollar auctions. What they do is they sell dollars and buy real. Again, selling dollars, buying real mechanically strengthens the real, but that's not enough because they keep doing it. And again, this buys some temporary reprieve, but at the end of the day, it doesn't solve the root problem of too much fiscal spending, and so the real just keeps selling off. Now, in line with the depreciating currency, looking at the local currency denominated government bonds over there, well, they're yielding about 14%. And obviously, that's very high. And so that does show a lot of concern about the fiscal situation. Looking at their stock market, these higher interest rates, this panic in the real has really seemingly led to some degree of capital flight, where people are just selling everything and taking money out. So their stock market has done very poorly. But the good news is, of course, their central bank is trying to do something, not just offering dollar auctions, but also hiking interest rates that are around 12% now. So it does seem like there is some degree of independent monetary policy at work, trying to fix the problems. Now, over the past few days, President Lula, who recently was in brain surgery, so he wasn't able to respond to this crisis, is now coming out and saying more positive things, being more market positive, saying that he's going to try to rein in some of this fiscal spending, and that's been giving some reprieve in the market. So we'll have to see if he actually follows through with his pledges in order to restore some degree of financial stability. But this instant, I think, should sound familiar to people because not too long ago, we were also talking about something similar unfolding in France. Of course, not to the same degree. As we all know, France is in some sort of a mini fiscal crisis as well, with their fiscal deficit around 7%, and with a government that doesn't seem to be able to change course. Now, we've already seen sell-offs in French government bonds. The euro, it's really hard to say. Again, France is just one country out, part of a much bigger union. Um, but so most of the distress there seems to be reflected in their bond market. But this is a situation that we really see across the world. Fiscal deficits rising and seemingly the market's having less tolerance for it. Now, one exception, of course, is the US. The US is very lucky. It is the reserve currency. So even as the US spends too much money, even as interest rates rise, it oddly enough leads to more financial inflows and a stronger dollar. And of course, uh, that may not always be the case, but at the moment it is. So looking forward, let's be on the lookout for more types of fiscal crises around the world because government spending too much, that is a tale as old as time. Okay, the second thing I want to talk about is the housing market. Now, many people were thinking that finally, after the Fed cut rates, we would have a rebound in housing. Now, the Fed cut rates by 100 basis points, but mortgage rates are still around 6, 7%. The reason for this is not because that the market is concerned about inflation, but because the market is less concerned about a recession and because the Fed has guided with more hawkish communication. So what's actually happened is that the market, let's say earlier in the year, was pricing a lot of cuts for next year and then beyond, but right now is only pricing in two cuts next year. So the market is taking out Fed cuts out of the future because, of course, Chair Powell did give a bit of a hawkish communication more recently, but also it seems like the economy in the U.S. is doing okay, so there's really no need for the recessionary cuts that were priced in. And as a result, longer-dated interest rates have been rising, mortgage rates with them. Now, this has been having a really negative impact on the housing market. If you look at housing starts in the US, again, they surged in 2022 when interest rates were very low. But over the past year, they've been, been coming down a lot. And so that suggests that housing is not doing as well as you'd think. Now, so far, looking at construction employment, you don't really see any layoffs. Construction employment remains strong. But if mortgage rates were to remain this high, you can easily see that you could have some problems for housing down the line. Now, in order to better understand what's going on, I listened to a couple earnings calls from large home builders. And surprisingly, well, not surprisingly, it kind of mirrors what we see in the broader economy. It is very much a K-shaped economy. Now, first, let's listen to what Lennar has been doing. Lennar is one of the largest builders in the US, so they target the mass market. And for Lennar, their most recent earnings call is really downbeat. Now, it looks like they missed their estimates by a large number of units. Again, selling much fewer units than they thought. The profit margins also lower than they thought, around 22%. And overall, they were basically sounding a pretty downbeat note. Now, they suggested that, the people have jobs, the wages are growing, everything is okay. But at the end of the day, house prices are high and mortgage rates are high. And so people haven't been able to afford the houses that they're building. They've been trying to move inventory by offering concessions, and that's been pushing their profit margins down. So it was not a good quarter for them, and unless mortgage rates come down, it doesn't seem like it's going to improve. Now, That is a pretty downbeat note. And if you look at the price of housing stocks, looking at this ETF, you'll see that the market kind of already reflects that. The Homebuilder ETF has totally tanked in recent weeks. However, let's listen to another home builder, Toll Brothers. Now, Toll Brothers, also a large publicly traded home builder, but not mass market. They tend to target the luxury market. So the average selling price for Lennar, about 400,000 US dollars. Now, the average selling price for Toll Brothers, about 900,000. So they do target a markedly more affluent consumer. And what Toll Brothers is saying is that things have never been better. They had their best year ever. It's been a banner year. And their margins, again, much higher than Lennar. It's around 27.5. And what they're saying is that, so yeah, mortgage rates are higher, but it doesn't really affect our home buyer. In fact, about a third of the people who buy homes from us, they paying all cash. Again, all cash on a 900,000 home. And the people who do have mortgages, they're putting down a pretty large down payment. So for them, they're noticing something pretty interesting. So the median first-time home buyer, according to data, is actually 38 years old, and that share of so median home buyer is around 38 years old, but overall in the markets, the share of the market that is first-time home buyer is historically at a multi-decade low. So what that means for them is that when people do buy homes for the first time, because they're older, they tend to be more affluent and they are more able to afford these pricier homes. Again, looking beyond the first home buyer market, a lot of the customers for Toll Brothers are move up people, move up home buyers. So people on their second or third homes now trying to upgrade and get a bigger home. And these people, obviously older, more affluent, and they're finding it just fine to go and move on to these more luxury homes. And I would suggest that this is largely due to the asset price inflation that we're seeing, whereas a certain segment of the population has been exposed to the equity market, to crypto or whatnot, and they've been doing very well, and they continue to convert their wealth into fancier housing. But for the vast majority of people, it seems like they really are struggling because they don't have as many assets, do not benefit from appreciation. So it really seems that the housing market is another reflection of the K-shaped recovery. Now, an interesting implication of this is that if we do, for whatever reason, have some kind of recession, on the one hand, all these affluent buyers will have fewer stock market gains. On the other hand, it seems like mortgage rates will come down. I would expect that that would probably benefit the common builders more, since their clients, don't have that much assets to begin with, although they would have their jobs at risk potentially, depending on their occupation. Okay, the last thing I want to talk about is what happened in central banking world the past week. So the past week we have meetings from the Bank of Japan and the Bank of England. Now in Japan, as we've been talking about, they've been discussing hiking rates. Now, Japan is coming out of a multi-decade prong in deflation, so they don't want to hike rates too quickly and kill off inflation, which they've been praying for years and years and years. Now, this past week, they did not hike rates, and it was perceived to be more dovish because the central bank there, Governor Wade over there, did not guide strongly for additional hike in January. So, again, market was thinking potentially a hike last week, didn't happen. Now the market would be thinking about January, but they also didn't receive strong guidance towards that as well. Now, the market widely perceives that this is going to happen in January or March. It's going to happen eventually. Looking at the data, inflation in Japan has been seemingly pretty stable, around slightly above their 2% target. So it seems like the central bank there would feel more comfortable about hiking rates, although they did not. Now, this past week, they also had a very interesting policy review come out, and the cliff notes from their over 200-page policy review seems to be that Governor Ueda would like to normalize policy. He gives himself a big pat on the back for his unconventional policy stimulating the Japanese economy, but he would seemingly want to prefer to be able to normalize interest rates, that is to say, get interest rates comfortably above zero, so that in the future, when they have a downturn again, they can cut rates and ease policy through conventional measures, rather than doing all this massive QE in the bond market, in ETFs, and so forth. But so far, though, it doesn't seem like he's strongly signaling uh, a rate hike, though the market really believes that he's going to hike very soon. Now, the reaction to the Bank of Japan's meeting was a pretty strong depreciation of the Japanese yen. Again, this is coming right after a Fed meeting that's perceived as hawkish. So together we had a massive, massive depreciation of the Japanese yen, dovish BOJ, hawkish Fed. So much so that on Friday we actually got some verbal intervention from government officials in Japan, warning that they don't like seeing the yen depreciate disorderly, and they could potentially intervene, which they've done a couple of times in recent years. So it seems like we are approaching that red line where the Japanese authorities don't like to see such a big disorderly depreciation of the yen. And of course, with President Trump waiting in the wings, and he's been very vocal about not liking other countries to um, have the appearance of unfairly manipulating their currency, that's something to watch. It seems unlikely that Japan would be able to tolerate further depreciation of the yen. So maybe that will prompt the Bank of Japan to do something soon. Okay, the second thing that happened was, of course, the Bank of England meeting. Now, the Bank of England did not cut rates, they were paused, but it was perceived to be somewhat of a dovish meeting because there were three people on the rate setting committee that actually dissented and wanted to cut. Now, taking a step back, the market, was kind of thinking that the Bank of England would be a bit hawkish because just before the meeting, the most recent inflation data was a bit hotter than expected, and wage data had been hotter than expected. But it seems like the Bank of England is going to dismiss those data prints, especially the wage one, as just volatile data and wants to continue to cut. It seems like they are becoming more concerned about growth, which was revised lower at the meeting, than inflation. So the market is widely thinking that the Bank of England is going to cut a few times next year. Okay, so that's all I prepared for today. Thanks so much for tuning in. Next week, I will put my markets outlook for 2025, and we'll go back to a regularly scheduled Markets Weekly the week after. All right, thanks for tuning in for this year. It's been a wonderful year, and Merry Christmas to everyone.